We've come a long way in our journey studying accounting. And what I like to do, and especially, some of the people that are in this class, some of the people watching this video are going to be accountants or may already be accountants. But there are plenty of people who study accounting courses and they're not going to be doing debits and credits, bookkeeping, preparing financial statements. They'll still be using that information in some capacity. So where I really like to go is to have people understand ways to determine if a company is healthy, is it sick, is it performing the way that we would expect it to perform, are there things that could be improved? And so that's what we really get at with financial statement analysis. Now, this is going to be an overview, certainly. I'm going to talk about some of the more basic techniques, some of the more common things that you encounter, some of the fundamentals. And what you have to keep in mind is you always have to consider the company, consider its industry, and don't forget about qualitative factors in addition to these quantitative things that we talk about. So let's start our analysis here. One of the most basic ways to analyze a company's performance is to do what's called horizontal analysis. Now, take away the fancy term. It's basically looking at a company's performance side by side. So we have an income statement here. And in fact, I should mention that we're going to use this relatively simple company, Blake's Coffee House, just to illustrate some of these more basic concepts. So we've got a pretty simple income statement here. We've got some revenue from selling food and beverages. Obviously, you have to subtract cost of goods sold to arrive at gross profit. We have operating expenses here. That boils down to an operating income. Gross profit minus operating expenses equals the operating income. Then we have a couple of non-operating expenses down at the bottom. Well, I should say one non-operating expense, which is interest, and then a non-operating source of income, miscellaneous income. If you combine the operating income of $245 with the other income, which is actually an expense because the interest expense is the bigger of the two, $245 minus 2 is $243,000, bottom line net income. Now, if we look at this horizontal analysis, what we're really doing is we're saying, what is the percent change from year to year? Because I don't know what you think, but as I look at this, I see a company that from 2017 to 2018, sales revenue increased. Sales revenue was $607 in the previous year, jumped by $20,000 up to $627,000. So we saw a 3.3% increase in sales revenue, which is terrific, right? Companies are always looking to grow their revenue sources. Sometimes I've heard business owners say that if you're not expanding, you're potentially contracting over time. Now, the concern I have, and see if you agree with me, revenue increased by 3.3%, but our bottom line net income, right down here, actually declined. 245 versus 243. So I'm wondering, why is it that we worked harder to serve more customers, earn more revenue, but we had a lower bottom line net income? Something there just doesn't quite add up. Now, I assure you, the numbers do. The math works out. I've triple checked it. But we have to try to figure out what are the reasons for this. Well, revenue increased by 3.3%. Great. Cost of goods sold increased by 0.8%. That's actually a trend in the right direction, right? Cost of goods sold really did not increase a whole lot here. So it looks like the company has done a pretty good job of controlling those costs. In fact, I would say an excellent job of controlling those costs. And that leads to a gross profit that actually increases by a greater percentage than the revenue percentage increase. Wonderful. Here's where the problem is. Revenue increased 3.3%. Cost of goods sold, or cost of goods sold was low. Gross profit increased by 3.9%, but our operating expenses increased by 9.3%. And what that caused was actually a decline in operating income, and the miscellaneous items, they were relatively constant. That's what's really causing our decline in net income, bottom line net income. So we start to take a look at some of the details over here. And one of these really stands out is advertising. $30,000 on advertising in the previous year, more than double in 2018. Now, certainly, I'm no marketing expert, no advertising expert, but I have to believe that if you double your promotional efforts, that is going to positively impact your sales revenue, and that might be part of the story here. But we have to ask ourselves the question, is that sustainable? Is that the proper level? Because it looks like the rest of the costs, they kind of fell in line pretty nicely. So the big question here is going to involve that advertising expense, and is that the appropriate level? But what you can see is this horizontal analysis basically is a trend analysis. And it doesn't have to be isolated to 2 years. It could be 3, 4, 5, or more years, whatever is appropriate for the decisions that you're trying to make for this company. Horizontal analysis also works very well with balance sheets. Now the balance sheet, it's got a little bit more information on it, so I actually split it between 2 screens here. But just like we saw with the income statements, horizontal analysis is essentially looking at the balance sheets side by side. This is December 31 of 2018. This is December 31 of the previous year. And we can see the cash position increased by 46%. Okay, that helps liquidity. Accounts receivable doubled. Now, it's a coffee house. Not very many receivables, maybe a few customer accounts or corporate accounts or something like that. So that's a relatively minor asset. But we saw a huge increase in inventory, 35.6%. And overall, you can see that the current assets increased by well more than 33%. Okay, pretty significant. Total assets increased by roughly just under 5% over there. And you see the side-by-side accumulated depreciation and whatnot. This, for example, the $15,000 versus the $6,000, that should reconcile with our current year depreciation expense and any disposed or sold assets. So what you can see is that you're looking at this side by side. The same is true with the liabilities and the stockholders' equity. And just looking at changes from year to year and looking at the magnitude of those changes, I would use this information in a few minutes. What you're going to see is we're going to be calculating some ratios. We're going to be evaluating the liquidity of the company, the profitability of the company, the solvency of the company. And it's useful to have this comparative information to make those analyses happen. Now, the other option here is vertical analysis. With vertical analysis, and I know this might be a little small here because we had to add a little bit of some extra columns over there on the right, but what vertical analysis is doing is it's sometimes called a common size analysis. We're taking elements of the financial statements, in this case the income statements, and we're expressing them in terms of a percentage of some element of that financial statement. For the income statement, what we typically do is we express things as a percentage of total revenue. So what you would expect here is that for 2018, well, revenue is 100% of itself. Same is true for 2017, okay, because pretty much everything in this income statement is divided by revenue. So for example, we're not going to do all the math on all of these, but this 19.6% that you see here as a percentage for cost of goods sold, that number is really $123,000, which is the cost of goods sold for the 2018 fiscal year, divided by $627,000 right there. That is your 19.6%. Okay? So we're just grabbing this particular number here, dividing it by the 627,000 here, and we're really doing that for each element here. Now, what this lets you do, remember how when we looked at the horizontal analysis, we said, oh wow, revenue increased quite a bit and cost of goods sold did not increase a whole lot. Well, let's see where that shows up in the financials. Okay, cost of goods sold as a percentage of sales definitely was lower for 2018 versus 2017. And that's exactly what we would expect when we saw that trend in the horizontal analysis. That's causing our gross profit to be greater, which is the right direction. But if you recall, the reason that our bottom line net income actually declined by a couple $1,000s, even though sales revenue was bigger, is that advertising expense more than doubled from year to year. And we definitely can see that stand out right here, okay? Previous year, it was 4.9% of sales. Current year, almost 10% of sales revenue. So these common size financial statements, what they let you do is they let you quickly and conveniently compare the relative performance of differing years where there might be different magnitudes of dollar amounts, or they can also let you compare companies of different sizes. What if you have a very large company and a smaller company and you're trying to compare those? What if you're trying to compare Coca-Cola and Pepsi, or McDonald's with Burger King with Wendy's in a particular industry? Just by the very nature of being independent businesses, one of them is going to be bigger, one of them is going to be smaller. What these common size financials let you do is boil down the performance to a percentage, which is a common size for all those various entities or for various years within the same entity, and then very quickly identify differences. If you were just going to kind of do this, I worked with a guy once who called this a two-finger flyby. If you just kind of go down here, pretty quickly, that 4.9 versus 9.9, that's going to stand out pretty dramatically. Also, the salaries and wages, it was a lot lower in 2018. So this very quickly lets you identify areas where you may want to investigate further. Just as we can do horizontal analysis for horizontal and vertical for an income statement, we can also do horizontal and vertical for the balance sheets. Probably a little bit less common, at least in practice, with the balance sheets, but it's certainly valid. Now, with the income statement, we expressed everything in a common size as a percentage of revenue. What we do oftentimes in the balance sheet is to express the elements as a percentage of total assets. So down here, total assets are 100% of themselves for each year. And just to kind of illustrate the cash percentage here, you have $22,000 of cash at the end of 2018. Total assets at the end of 2018 are $366,000. And that's where you're getting this 6% value right here. The other percentages are calculated similarly. So this can be a good way to look at the composition of your balance sheet, to know that cash is a greater proportion of your assets at the end of 18 versus 17. Yeah, that's helpful in analyzing the liquidity. Looking at the inventory, seeing that inventory was roughly 13% of total assets. Now it's approaching 17% of total assets. That might start to cause some questions about are we doing a good job in controlling our inventory? Because companies do need to minimize their inventory, especially a company like this where we have perishable food products. There's a risk that those items could spoil, and then we would have waste, which would turn into an additional expense. Plus, you have to buy the inventory, you have to store it, you have to count it. There's all sorts of reasons that you want to minimize your inventory to reasonable levels. So you can see things like that just kind of stick out very quickly as you're looking at a common size balance sheet. And the balance sheet spills over into a different screen just because there's so much more content here. But again, side by side, vertical analysis, each of these liabilities and elements of stockholders' equity are expressed as a percentage of total assets. It can be a wonderful way to identify major changes and trends as we look at the financial statements. Now, where we really want to head with this is to look at some metrics. And I call them metrics because a lot of them are ratios, but some of them are more just calculations. Now, as you are analyzing a company's health, okay, if you're going to be able to tell me, is this company healthy? Is it sick? Is it doing well, but there's room for improvement? Would I loan money to this company if I were a bank? If I were an investor and I had some spare money to invest, would I invest in this company? Would I want to work for this company? If I'm a supplier, am I willing to extend credit, accounts payable, trade payable to this company? Okay. If I'm a governmental entity, would I grant this company a construction contract, for example? These are all decisions that need to be made based upon the strength of the company's financial performance and its financial position. And that's what we're going to really look at as we go through the next little bit of our discussion here. I like to divide the analysis into three major areas. Liquidity. And with liquidity, what we're really looking at is the short-term health of the company. You know from our previous discussions and your other studies that current assets, for example, are those assets that are cash, or they're expected to be converted to cash within the next year, or they're expected to be consumed, used up within the next year. And current liabilities are liabilities that are going to come due and need to be satisfied within the next year. So if we're going to analyze liquidity, we're looking at things like, what is the relationship between current assets and current liabilities? Are the current assets bigger than current liabilities, which is favorable for liquidity? And there are other metrics we're going to talk about in a few minutes. So with liquidity, we're looking at the short-term health of the company. In other words, do we think this company is going to survive within the next year? That's kind of a fundamental question. Then we can analyze solvency. Solvency is the long-term health of the company. Will it be around 10 years from now, 20 years, 30 years down the road? Okay. You can look around you in your community, and I guarantee you'll find businesses that have been around for a long time. There's a major retail chain here in West Michigan where I'm putting this video on right now. And I believe they were formed in the 1940s. And they're still a very robust entity. I've never looked at their financial statements, but they clearly are successful. That's a solvent company. So looking more at the long-term health of the company. And then I also like to look at profitability. And profitability really has an impact on both the short-term and the long-term health of the company. Profitability is looking at the operations of the company and looking at the revenue relative and expenses relative to the revenue. Are we doing a good job of controlling our expenses? Basically, how are we doing at generating a profit? So the next little part of our discussion here is going to focus on specific metrics that you can calculate to assess liquidity, solvency, and profitability. Let's take a few minutes and talk about liquidity. The kind of the gateway ratio for liquidity is the current ratio. All you're doing here is you're taking your current assets and dividing them by current liabilities. So for 2018, your current assets are $91,000 that you have right here. Your current liabilities, I've got these balance sheet excerpts for you, are $51,000. So your current ratio ends up being 1.8, which on the surface seems pretty good. Now, you have to ask yourself the question though, is it good? How do you know that that's good? Well, a good starting point is at least our current assets are bigger than our current liabilities, but I would like to look at the company's trend. So if we go back a couple of years here, in 2016, the current ratio was 1.4, then it bumped up to 1.8, and it stayed at 1.8. So that is a trend in the good direction. With current ratio, bigger is better, bigger is safer. And oh, by the way, the industry average is another benchmark that we can look at. So the industry average was 1.1. We're beating our competitors in this regard. So as I evaluate liquidity, at least based upon the current ratio, I would say, yes, this company has sufficient liquidity. It's above the industry average. It's trending in the proper direction. And those are all positive signs. Now, should it be even bigger? I don't know. That's a facts and circumstances type of question. But at least we know we're heading in the right direction and we're beating the industry average. Now with the quick ratio is kind of like the current ratio, but the numerator is different. We're still looking at our coverage of current liabilities. So the denominator here will be identical to the current ratio. But the numerator does not include all of the current assets. It only includes cash, current receivables, so in other words, receivables that are very likely to be collected, and then marketable securities, which are things that we could easily liquidate if we needed cash. So look what's excluded in this case. Inventory, we have to sell inventory in order to turn that into cash. So inventory is too far removed from becoming cash for us to include it in the quick ratio. Prepaid rent, you're probably never going to turn that into cash. Are you going to ask your landlord for a refund? Probably not. Prepaid rent does mean that you get to occupy premises or use some machinery or equipment for a certain period of time without paying additional rent. So prepaid rent is a benefit. There's no doubt about that. But it's not a very liquid benefit and not a very liquid resource. So the quick ratio only looks at those highly liquid components of current assets. And in this case, since the coffee house does not have any stocks, bonds, investments that would be marketable securities, we're only looking at cash and accounts receivable, which is where the $24,000 comes from. Much more conservative measure of the company's ability to stay in business in the short term. And what we're seeing here, this is lower than 1, okay? And that's not uncommon for a quick ratio. So we have to look again at the trends in the industry average. 0.3 is the industry average. We're beating the industry average. Trending in the right direction, 0.3, 0.4, 0.5. Again, just like with the current ratio, this is a sign that the company's liquidity is trending in the right direction. Those two ratios are wonderful, but you really need to look at the magnitude by looking at the working capital. Let me just give you a quick example. This would produce a current ratio of 1.8. If you had $1.80 in current assets and you had $1 in current liabilities, that would give you a current ratio of 1.8. But your working capital, which is current assets minus current liabilities, your working capital would be a whopping 80 cents. Now, I don't know about you, but I might be perfectly happy with a current ratio of 1.8. But if I know that translates into 80 cents of wiggle room that determines whether or not I'm going to be surviving for the next year, that tells a different story. That's why you really have to look at the working capital in concert with the current ratio and or the quick ratio. Just take a look at it right here. For 2018, our current assets were $91,000 at the end of the year. I'm just grabbing that from below here. And our current liabilities were $51,000. Nothing too complicated with the math on this, folks. Difference between those two is $40,000, and that's the magnitude of your working capital. So working capital is heading in the right direction for this company. There's really not a way to have an industry average because it really depends upon the size of the company. So I didn't have an industry average for this, but you can see that this particular company is going from 15,000 to 29 to 40,000, all heading in the right direction, all signs that the liquidity is positive for this entity, and it gives us a kind of a warm, fuzzy feeling about their liquidity. With all of the metrics you see here, bigger is better, bigger is safer. A couple other measures of liquidity involve our accounts receivable. As you may recall, accounts receivable represents funds that customers owe to us. We have generated sales revenue, we recorded it on the income statement under the accrual method of accounting, and then we wait for the customers to pay us. So obviously there's a risk that we wouldn't get paid. There's also a risk that we would not get paid as quickly as we would like. So two of the metrics right here help us determine factors that affect liquidity. These are really more influencers of liquidity, if you will, because if you're collecting your receivables more quickly, your liquidity is probably going to be better than if you were collecting them slowly. And that's why we take a look at these two ratios. So the turnover ratio takes your net credit sales. Now, not your net overall sales. So if we look at the coffee house, we had total revenue of $627,000. But it's a coffee house. And the vast majority of their sales are cash, or I would put credit cards in terms of cash. I mean, obviously people pay with credit cards, but that's an ultra short-term receivable that gets collected within a day or two from the credit card processing company. So credit card revenue, I lumped that into cash sales. What I'm talking about with credit sales is where we actually extend credit to customers, maybe to a local business or somebody with a customer account. And there's a true risk that we might not get paid, or we might not get paid in a timely manner. So you take a look at the credit sales, okay? Because obviously with the cash sales, if you have no risk of getting paid, we don't really need to worry about that. And then divide by average accounts receivable. Now, average accounts receivable is going to be your beginning plus your ending divided by 2. So all the way down here, here's our average accounts receivable. 1,000 plus 2,000 is 3,000 divided by 2, $1,500, right? And you could actually, in this case, just eyeball it, right? Halfway in between 1,000 and 2,000 is $1,500, but that's where this $1,500 is coming from. And the calculations are very similar for 2017, 2016. Now the question is the turnover ratio good? Is it heading in the right direction? Well, this isn't quite as rosy as those liquidity numbers we looked at a few minutes ago. You want bigger is better. With the turnover ratio, bigger is better. Because what this means right here is 45 times during the year, we generated sales and receivables, we collected the revenue. Generate receivable, collect the revenue. It actually declined in the next year to just under 42 times per year, and then declined a little bit further for 2018. Not the right direction, okay? What's happening, and you'll see that in a minute when we look at the collection period, it is taking our customers longer to pay us, okay? We're waiting longer to get our cash. And that's really where the average AR collection period comes in. Now, with the collection period, lower is better. What you want to do is take the ratio that you determined from above, okay, for each particular year, and then simply divide that into the number of days in the year. If you collect your receivables 40 times per year, well, just say 9 times 40 is 360, so that's about 9 days that you're waiting. So the average collection period is actually getting longer, which is what we would expect if the turnover ratio is declining. We used to wait 8 days to get paid. Now it's closer to 9. Now it's a little bit above 9. Now that may not be a really important metric for this particular business because a vast majority of their sales are cash sales. But for businesses that rely heavily on credit sales, this can be huge because if you're waiting a longer period of time to get paid from your customers, you're going to have difficulty paying your suppliers and your employees and your bank loans and whatnot. And you're going to have to rely on lines of credit or other sources of financing to try to bridge that gap. That's why you want to see accounts receivable turnover ratio, higher is better. Average AR collection period, lower is better. And oh, by the way, with that in mind, they're below industry average. Industry average was bigger here and it was lower here. So in this regard, we're not heading in the right direction. It's not exactly up to par with industry average. Probably warrants a little bit of investigation to figure out why, but it's also not the major portion of our sales, so we may have to consider what impact that has overall. We looked at accounts receivable, the turnover ratio, the number of days it takes to collect our receivables. Now we can look at a different asset, inventory. Now with inventory turnover, again, what we want to see here is we want to have a higher turnover ratio. Think about the extremes, okay? I like to think about a sushi restaurant, okay? I don't know if you like sushi. I do. I like fresh sushi. If I'm going to eat some fish that's uncooked, it's got to be pretty darn fresh. So I would like to see their average number of days in inventory for a sushi restaurant be extremely low. And I would like to see their inventory turnover ratio be extremely high. Just take this as an example. If your inventory turnover ratio was 365.0, think about what that means. That means that 365 times during the course of the year, you purchase inventory, deplete your inventory. Purchase it, deplete, okay? Have some, have none. You do that 365 times during the year. Now, obviously, most businesses don't completely deplete their inventory to zero and then replenish it. There's always some kind of safety stock. But that's the concept here, is that effectively that's what you're doing, okay? Now, if you can translate this to the number of days, and remember this is an extreme example. If you take the number of days in a year, 365 days, and divide that by your inventory turnover ratio that we figured out above, coming from here, that means that your average inventory holding period is 1 day, which is what I want for my sushi restaurant. Now, industry average makes a huge difference here. If you're a car dealership, 1 day is not realistic, right? If you're Boeing or Airbus making large jetliners that take over a year to manufacture potentially, then 1 day is obviously unrealistic. But for a restaurant or some company that has perishable goods like a produce market or a butcher shop, something like that, we would expect to see the number of days be lower. So as we take a look at the liquidity for this particular coffee house, we have the inventory turnover ratio, and here's how it's calculated. You take the cost of goods sold for the particular year. So I'm grabbing that from our 2018 income statement. And then you take the average inventory for the balance sheets that are on either side of the income statement. This is how much inventory was at the end of 2017. Here's at the end of 2018. Average those together. In this case, it is $53,000. Divide that into the cost of goods sold for the year. That's where we get this turnover ratio. Now, bigger is better. Bigger means that we're cycling through our inventory more quickly. And what we're seeing is we had 3.7 down to 3.1 down to 2.3. Not the direction we want. And far below the industry average. The industry average is to go through your inventory 10 times per year, which you would expect, by the way, 10 times a year would translate to, on average, holding your inventory for 36 and a half days, since there are 365 days in the year. Let's look at what's happening with our company. Okay, here it was just shy of 100 days. As the turnover ratio drops, the number of days that we keep our inventory on hand is increasing. That's an element of concern for this company. Now, their cost of goods sold, their inventory, is not completely perishable products, right? Obviously, they're going to have coffee beans and syrups and baked goods and things like that that would need to be replenished very quickly. But they also may have packaging products and napkins, plates, things like that, and that would be in the mix, and those could be stored for a long time. So I would say that if I were looking at this particular trend, I have some questions, and I want to know how well we're managing our inventory. We are almost finished with our analysis of some of the more common liquidity metrics. We looked at accounts receivable, we looked at inventory. Now we need to turn the page and look at a very important current liability, which is accounts payable. If we're taking a look at our trends in liquidity, we're looking at what are the things that are impacting that liquidity. And collecting receivables is certainly part of the equation. Managing our inventory is another component. But then how do we do with our cash disbursements? Because accounts payable is the liability that is owed to our vendors. And we want to do a good job of managing that. Now, with the inventory and accounts receivable turnover ratios, we said higher is better. Theoretically, because we're on the other side of the balance sheet with liabilities, theoretically we would say here lower is better. Within reason. You don't want to abuse your vendors, okay? So, I mean, if they're going to extend 30 days credit to you or 60 days or whatever that might be, certainly work within those guidelines. But if you start to delay payments to vendors, eventually they're going to do things that you don't like perhaps cut you off and no longer supply you with goods or services. So you've got to maintain a positive relationship with your vendors. If you lose a critical supplier, that is actually something that could detrimentally impact your business in the long run, right? That if you can't get access to key components, key ingredients, you're going to have a hard time making your product that your customers want to buy. So within reason, on the turnover ratio here, lower is better. Within reason, on the number of days in payables, higher is better because you're stretching out those payables a little bit longer. How do we calculate it? Just like we did with accounts receivable and with inventory, we're taking an income statement account and dividing it by an average balance sheet account. So your cost of goods sold for the year was $123,000, right there for 2018. The average liability for accounts payable, add these up and divide by 2, you get to an average of $31,000. And that means your turnover ratio was 4 times during the year. 4 times during the year, we cycled through our accounts payable. And if you take that ratio and divide it into the number of days in the year, that means that on average, we paid our payables in 92 days, which honestly seems a little bit excessive here. I don't like to go beyond 30 days with normal business trade agreements. Now, every vendor is going to have their terms. Maybe we've negotiated some ultra favorable terms. I'm not sure. Or maybe it's just the nature of the industry to stretch these things out. So you want to look at the trend. And in this case, the company is trending in the right direction as long as they're maintaining healthy relationships with their suppliers. The number of days is going up a little bit. That means we're stretching out our payables. These are just things to consider. So those are certainly not all of the liquidity metrics you could take a look at. In fact, I have this wonderful book here. You can't read it, and it's going to be backwards in the video, but the Quick Reference Guide to Key Business Ratios. What is it about? 18 pages, lots of different ratios in there for lots of different things. And there's no way we're going to go through all these ratios. What I'm giving you here are some of the more common ratios that are going to give you wonderful information about a company. But of course, if you want some more detailed metrics, there are a ton of them. You just have to research. Google will do a wonderful job, or your textbook. And if you need something that goes beyond the scope of what we're doing here. So let's turn the page now and look at profitability and solvency. There are 3 metrics that I would like us to discuss when it comes to solvency. As a reminder, solvency is measuring the long-term health of the company. Now, the debt-to-equity ratio and the debt-to-assets ratio, really lower is safer. And we'll talk about that more in a minute. With the times interest earned ratio, larger is actually better, more preferable. Let's look at the calculations here a second. Debt-to-equity, total liabilities divided by total stockholders' equity. And these are balance sheet amounts at the end of the year. So total liabilities, $80,000 up there. Total stockholders' equity, $286,000. And then it's simply the ratio of those two. Now, when we look at debt to total assets, it's the same total liabilities that we had from up here, right? But now we're looking at the total assets of the entity, not the stockholders' equity. So really assets and liabilities, or liabilities and equity combined. Both of these are measuring the capitalization of the company to some regard. What we're basically saying is how much debt do we have relative to the owner's investment? How much debt do we have relative to the assets of the company? And in both of these regards, lower is safer. Now, there is an argument that if you use debt to capitalize your company instead of owner's equity, that the owners may be able to realize a higher return on investment. And I'm sure that when you have a finance class, they'll talk about that in much greater detail. So debt is not necessarily bad or inherently unhealthy for the company, but it's one of those elements where you have to keep it in check. There are healthy levels of debt, and then there are levels of debt that can cause serious problems for a company. Leverage certainly can increase your return on investment, but that same lever that gives you the leverage, for lack of a better term, to potentially increase your ROI can swing back and hit you in the face and cause some real damage if there are tough times in the business, like a recession or a depression or something like that. So that's a long way of saying that with these 2 ratios up here, debt to equity, debt to total assets, lower is safer, even though a healthy level of debt is certainly acceptable. So as we look at this company, they've maintained 0.3 for their debt to total assets. That's far below the industry average. They've also debt to equity, I misspoke up there, 0.3. Debt to total assets has been 0.2. Also very low, very stable, and below industry averages. So I would say that the solvency of this company, based upon these two ratios, the first two ratios, is very favorable, very safe position. Now, the other thing we can take a look at is the times interest earned ratio. And what this is basically doing is it's looking at how much income are we generating relative to our interest expense. Bigger is better here. There's no doubt about it. Bigger is safer. How much profit are you generating? Can you at least cover your interest payments? And how many times over could you cover those interest payments? So that's probably pretty obvious and not difficult to understand, that we're making net income divided by interest expense. Okay, I get that, Chris. What about this? You're saying, well, why do we add back the interest expense, and what about this income tax expense? Well, we're going to take interest expense out of the picture because we're trying to equalize the playing field. What if a company were capitalized heavily with stockholders' equity and not as much debt? They wouldn't have as much interest expense. So we take interest expense out of the equation. And because interest expense is tax deductible for companies, we also take out the income tax expense to kind of level the playing field here. Now, in this case, I set up this fictitious coffee house as an S corporation. S corporations are not tax-paying entities. They are tax reporting entities. The profit from an S corporation, this $243,000, or the taxable equivalent of that, would actually get reported on the owner's tax return, their individual tax returns, and the owners will pay the tax. So in this case, there is no income tax expense for this particular coffee house. So what we're doing with this then, we're taking the $243,000 of net income. We'll just put that over here. $243,000 of net income. And then we add back the interest expense of $3,000. Now, the reason that interest expense is negative because it's part of this other income and expense category, which could be either positive numbers that make net income bigger, it could be negative numbers that make net income smaller. And in this case, it's a negative number, but we're going to treat it as positive for this calculation. And then we divide by the interest expense of $3,000. So what we're basically saying is, if we did not have interest expense, our company's profit, the net income, would be $246,000. Take that $246,000, divide it by the interest expense, and you get a times interest earned ratio of 82, which is terrific, okay? This company's times interest earned ratio is going in the right direction. It was 45, it's 62, industry average is 25. Those are very strong indicators of solvency. This company is clearly generating sufficient income to make its interest expense payments and then some, many, many times over, which means that it probably has excess cash flow to pay to the owners. And we'll see that in a minute because there were dividends paid to these owners. Now let's look at profitability. We looked at liquidity, which is the short-term health, solvency, which is the long-term viability of the entity, and we turn the corner to profitability. You already saw this. This is your vertical analysis of an income statement. Horizontal would have been percent change from year to year. Vertical analysis is each element expressed as a percentage of total revenue. So you already saw that. What I added was this column over here. Sometimes we will look at key industry averages, and you may not have granular detail regarding specific types of expenses, or even really some companies may classify things a little bit differently. But what we're seeing here is most companies would be able to report big subtotals like cost of goods sold, gross profit, operating income, net income. And now we can compare ourselves to industry averages, to other companies that do the same thing that we do. So we would ask ourselves, remember, gross profit was trending in the right direction for this company because sales went up, we controlled the cost of goods sold, and we see that gross profit increased from just under 80 to a little over 80. And that seems to be in line with industry average. Industry average hovers right around 80. As we might also recall, the reason that we saw a decline in net income, even though revenue was greater, we're serving more customers, was because our operating expenses, in particular advertising expense, was the big one there. So look at this. Our operating expenses as a percentage of net income have been hovering 39 to 41%, something like that. Industry average is 50%, okay? So even though we're going in the wrong direction, we are beating the industry averages. Operating income industry average around 30%. We're coming in hovering above or below 40% right there. So even though it's not quite as good as what we thought, it's better than our peer group. And all the way down here, yes, net income as a percentage of income, as a percentage of revenue, dropped from 40.4 to 30.8. Still better than the industry average. So these are signs that we are actually generating profitable sales. I would want to take a look at more than a 2-year trend for this company. Now, it's a relatively new company too, so that makes it difficult to get that kind of history. But you're looking at 1 year versus another year. That really is a small snapshot. I would feel a lot more comfortable if I could see 3, 4, 5 years, 10 years, some kind of trend like that. That would tell me really what the trajectory of the company is from an operational perspective. These are a few more metrics that you can use to assess profitability. I'm not going to go through the detailed calculations. I mean, by this stage of the game, I've showed you how to calculate several of the liquidity and solvency metrics, and you can really translate that quite easily into these profitability metrics. You guys know where to go in the income statement, the balance sheet, to figure out these amounts. And the math is easy to do, and in fact, you should be having a computer do it for you. I did. I made all these in Microsoft Excel. This is not an exercise in how to calculate division problems. I'm more concerned with understanding what does the information tell us. So let's take a look at each one of these. Return on assets. Net income divided by average total assets. What level of profit are you generating relative to the assets, the resources of the company? Here, bigger is better. Industry average, 0.5. We were above industry average. We're even more above industry average. We settled back down to 2016 levels there, but it seems acceptable. Okay, we're above the industry average, and we're hovering in a stable environment there. I'd like to see more years, of course, but with what we have here, that's fine. Asset turnover ratio. Now, you got to be careful with this one. Look at the difference. Asset turnover ratio almost looks like the return on assets. They have the same denominator, but the difference in the numerator is really, really critical, guys. And that's because the return on assets takes your bottom line net income, the bottom of the income statement, the profit that we're generating. Asset turnover ratio only looks at sales. So bigger is better as long as sales are at a profit level that you consider to be acceptable, as long as they're sufficiently profitable sales. Let me give you an extreme example. Let's say that your sales are increasing and your asset turnover ratio is then increasing, but you're selling your items below cost. So you're generating a loss with every item you sell to a customer. If you have a higher asset turnover ratio, you're simply digging your way to bankruptcy more quickly in that example. So the asset turnover ratio is an activity ratio. It's measuring what kind of activity are we generating relative to our investment in assets. If it's a profitable company, bigger is better. But there is that one caveat. So are we beating the industry average? Absolutely. And we're kind of hovering in that 1.8, 1.9. Seems like it's trending just fine. Return on common stockholders' equity. Now, we may not have talked about this a lot in previous videos, but you may have read it in a book, I'm not sure. But preferred dividends. See, companies can issue different classes of stock. Common stock and preferred stock are two typical popular flavors, I should say. Can't use the word common twice. Now, common stock is what you automatically think of when you think of shares of stock. But if a company offers preferred stock, what that often means is that the preferred shareholders don't have the right to vote in corporate matters. However, what makes them preferred is they get to be first in line for dividends and then also potential liquidation rights if the company were to liquidate. So in other words, the preferred shareholders don't get to vote, but they get dividends. It's like the amusement park when you get the fast pass line at Cedar Point. They're in the front of the line for dividends. That means that the common shareholders only get dividends after the preferred shareholders have received what they're supposed to. So if we're trying to figure out the return on common shareholders' equity, we've got to subtract these preferred dividends because they're simply not available to the common shareholders. Now what we're looking at then is what is the net income that's available to the common shareholders divided by their average equity, and we would expect that higher is better. And another profitability metric that looks good for this company, industry average is 0.5. We've been steady at 0.9. We should be happy with that. Fixed asset turnover. What level of sales are you generating with the fixed assets you have? It's another activity metric. You could draw some analogies between the asset turnover ratio and the fixed asset turnover because, well, fixed assets are a subset of total assets, right? So in other words, our investment in infrastructure, equipment, buildings, those types of resources, what are we doing with it? Are we generating sales? Now, the fixed asset turnover ratio can be calculated net or gross. And what I mean by that is, you guys know that on the balance sheet, you've got the asset, which is going to be a certain value, but then we subtract accumulated depreciation, which is an offset, right? And that comes out to a net book value if we combine those two. So all we're saying with gross versus net, you could calculate it based upon this number, which would be gross, or you could calculate it based upon this number, which would be net. And either one is going to give you information about the profitability of the company as long as you're consistent with the metrics. In this case, both of ours are exceeding the industry average for 2016 and trending in a direction that's even better. So these are all signs that indicate the company is doing a terrific job controlling its profits. And we're going to see that show up in just a minute. We're going to take a look at the statement of cash flows, and you're going to see that this company has been paying dividends to its shareholders. So it's generating profits, it's generating cash flow, and then it's getting that cash back into the hands of the owners. So let's take a look at some of these other considerations now that we've looked at liquidity, solvency, and profitability. There are a lot of things that we could take a look at. Sure, I gave you a sampler of metrics for liquidity, for solvency, for profitability. We looked at the horizontal analysis, the vertical analysis, and there are clearly lots of other things that we could do to digest the information we need to determine the health of the company. This analysis would be incomplete if we did not look at the statement of cash flows. Simply because there are things that show up on the income statement, revenues, expenses, that the timing is different than the timing of what impacts our checkbook here. Okay, so we really need to see what happened to the company's cash accounts and then take a look at the statement of cash flows in concert with the income statement and other metrics to evaluate the health of the company. Operating activities in the long run must be positive in order for the business to be sustainable. Okay. Now, occasionally, a company may experience a year, an anomaly, where operating cash flow is negative. It's actually an outflow. We would label it cash used for operating activities. And that happens. But in the long term, sustainably, you need to have operating cash flows that are positive. Because you'll see this in a minute when we switch to the other part of the statement of cash flows. But statement of cash flows, in fact, let's take a look at it. It really has three main sections. Operating activities, which is the cash generated or used in your day-to-day operations, your core business. Then there are investing activities, which I didn't include any here because I tried to make a simple example. What I did do is I took the operating cash flows, 248 and 209, and I kind of repeated that row right here. This is a continued statement of cash flows. And I purposely did not include any investing activities because I wanted to keep the example relatively simple and, quite frankly, in a font size that would fit on these screens here. As a reminder, investing activities, the outflows would be things like the purchase of equipment or buildings, fixed assets, we would call them. Also could be inflows from selling those types of assets. Could be making loans to other companies or individuals and collecting on those loans. So those are things, but primarily fixed assets is what we often think of. Then you have your financing activities, which is really, there are four main options here. Did you receive money from borrowing long-term, or did you repay principal long-term? Did you receive funds from issuing additional stock to investors, or did you pay dividends to those investors? Now, if we think about, that's not the only things that would show up there, but those are the four big categories that you normally encounter. So if you think about it, if our operating cash flow here is negative, then how are we going to come up with the money to pay those bills, those operating cash flows? Well, you could sell the investing activities that we have here. So in other words, you could sell your equipment and your buildings. Yeah, that'll give you cash, but that's a one-time thing. And if you sell all your equipment, you probably don't have a sustainable business anymore, right? You could borrow more money from the bank, but it's going to be difficult to convince a bank to lend you money if your operations are bleeding cash. And the same thing is true with investors. You want to ask an investor to come and continually invest additional funds into your company when all those funds are doing is bleeding out the door in operating expenses? So ultimately, yes, operating cash flow needs to be positive. One of the things I like to look at is the relationship between your accrual basis net income, okay, because this is what's coming off your income statement for the year. So the relationship between accrual basis net income and your operating cash flow for the year. If you see those numbers diverge, that can actually be a sign that we have some health problems with the business, maybe even a sign of fraudulent financial reporting. Because if you're seeing that this net income is getting bigger and bigger, and take, for example, the operating cash flow is stable or maybe even getting smaller, and we see accounts receivable getting bigger and bigger, it's possible that what's happening is the company is just recording fictitious sales. Those sales revenues boost the net income, boost the accounts receivable, but as you can see here, when accounts receivable goes up, we have to subtract that from our income when arriving at cash flows, because an increase in receivables is an increase in net income that did not yet result in the collection of cash. That's just one example of things, relationships you can take a look at with the statement of cash flows. There's a lot more we could discuss. I just want to make sure that statement of cash flows gets its proper treatment and that we make sure that we consider it as we're analyzing the health of the company. What's healthy for statement of cash flows for an entity? That's not a one-size-fits-all answer. And in fact, a lot of that context can depend upon the life cycle or the life stage of the company here. So look what I have here. I've got financing cash flows, operating cash flows, investing cash flows. And then I've got four potential life stages for an entity. When it's a baby company, brand new, trying to grow its legs, look what's happening. Financing cash flows are positive right here. Because where is the cash coming from? It's coming from investors and lenders. That's where a baby company is going to get its money. And where is that money going? Well, investing activities right here are going to be negative, using cash. Think about, I don't know, let's just say a pizza restaurant. If you were building a brand new pizza restaurant, you would be getting money from investors and or creditors. And then you would be investing in things like ovens, furniture, cash registers, maybe a building, that type of thing. And as you're building that business, your operating cash flows have a very good chance of being depressed or negative, especially if maybe, let's say, it takes 6 months to build the restaurant and you have to keep your lights and the heat on and insurance. And there are all sorts of operating expenses that a business can incur before customers even start to give money to the company. And then the company grows. And what we see is eventually a healthy company will hit that point where operating cash flow becomes positive, which we know in the long run, operating cash flow has to be positive for a successful business. And as the company grows, now during the growth stage, we still might be investing in infrastructure, adding locations, adding equipment, that type of thing. But eventually, things kind of level off. And when we reach maturity, right, then we're probably not investing anymore. We already have the tables, the chairs, we already have the ovens. Okay? So let's just run the business. And, oh, by the way, too, we rely less and less on financing from outside sources, whether that be investors or lenders. And look what happens here. As the operating cash flow in the mature stage is nice and positive, we can do things like this right here, repay debts, maybe pay dividends to our investors. So the financing cash flows actually become negative. Now, this is a very healthy stage right here, generating nice positive operating cash flows. We don't have to invest in infrastructure, and we're giving money back to our shareholders and probably paying down debt, right? That's a nice sweet spot. Now, if a company eventually hits the decline stage, now, not every company does, but plenty of companies do, look at what it would look like. Okay, how do these cash flows look when we get to that decline stage? The operating cash flows may certainly start to trend toward negative. Now, the investing cash flows become positive. Think about what's happening. If a company is in decline, it's probably going to sell its productive assets. Sell those ovens, those tables, those chairs, the buildings, delivery trucks, things like that. That's going to generate investing cash inflows. What are we going to do with those inflows? Well, at the end of the day, the residual value or the residual amount is going to go to the investors. So we're going to pay off our debts, and then whatever's left over goes to the investors. That's the concept of owner's equity. So the analysis of cash flows really depends upon what stage you're in: introductory, growth, maturity, decline. And you also have to look at it in concert with trends within your same company, industry, averages, things like that. But the stage of the company is very critical. There are a number of other things we should consider as well. This is just a short list of maybe some of the more important considerations. The quality of the financial statements. Are they audited by an external independent auditor? Or maybe they're reviewed, which, just for reference, audited financial statements provide what we would call reasonable assurance, and reviewed financial statements provide limited assurance. So it's less of an assurance level, but it's still, it is still a level of assurance, and there is the involvement with an external CPA. Or maybe it's just compiled financial statements, which for those, the CPA does not express any opinion or conclusion. They simply help the client get those financial statements in proper form. Might not even be audited. It could be just something that the client printed out of QuickBooks or Sage 50, something internal that they did. Or it could be just an Excel document that they give you. So you have to look at that. What is the quality of the financial statements? Audited financial statements should be more reliable than other forms of financial statements. Budgets, those come into play. Okay, not a bad idea to take a look at what was our budget for the year, what was our actual performance, what variances exist, and then investigate some of those variances. Did we operate in accordance with our plan? I put accounting policies here. What I'm really thinking about is, there are estimates and judgments that management can make. Think about this for a second. LIFO versus FIFO for inventory. That's one potential policy that could differ between companies. What about for, let's say, depreciation? Let's say we have straight line depreciation versus double declining balance. Or maybe we choose an asset life, useful life, 5 years versus 7 years. These are all reasonable decisions that companies could make, and they could differ between companies. So you have to make sure that we're comparing apples and apples. If you compare a company that uses LIFO with a company that uses FIFO without making an adjustment for those differences, you're not going to be comparing apples and apples. Concentrations of risk. What we're talking about here is that sometimes companies will have a very heavy reliance on a key customer or a key supplier. Let's say that 60 to 70% of a company's revenues come from one customer. That's huge. That's going to need to be disclosed. What if you have a key supplier that if that supplier were to hiccup and not be able to provide you with your raw materials or your ingredients, you wouldn't be able to serve your customers. That's stuff that we need to know about. Commitments and contingencies. What kind of skeletons are in the closet? Did we guarantee a loan from another company? Have we made a commitment to purchase a certain amount of raw materials at a certain price? Did we get sued? And what is the outcome of that lawsuit going to be? Is it probable? Is it remote? Is it likely, reasonably possible? How do we know about these things? Well, where you come for this information, and this isn't the only spot, but we would look at the notes to the financial statements. I've had bankers and other users of financial statements tell me that they actually go to the notes of the financial statements first. And for most companies, the notes to the financial statements, they're going to be after the balance sheet, after the income statement, after the statement of cash flows. The notes to the financial statements are supposed to explain and amplify the financial statements. They are supposed to provide context for the financial statements to give us some of the answers to questions we have. So if you wanted to know whether the company is using LIFO or FIFO, that was kind of one of our questions here. What are the policies? Well, guess what? It might be a little hard to see here, but this company uses FIFO right there. Fully disclosed right there. Later on, concentrations of credit risk was one of our questions right over here. Do we have any concentrations of risk? Right here. It says the company maintains a cash balance at one bank that occasionally exceeds the amount insured by the FDIC. So there's a little bit of risk. We've put people on notice. What about commitments and contingencies? If this company were party to a lawsuit, a defendant in a lawsuit, later on in these notes we would see some discussion of that, whether it was probable or reasonably possible. If it was remote, the contingent liability were remote, it wouldn't show up here. But these are the types of things that we can get from the notes to the financial statements. These notes are typically many, many pages long. The more complicated the company, the bigger the company, the longer the notes to the financial statements. But full disclosure financial notes really give us that context that we need to help to understand what story is being told by the financial statements. Now, of course, you can always ask management, and that's fine if it's a local, small business, family-held business. You can often access management and get some of these answers. But if it's a large publicly traded company, you're not going to have direct contact with the CFO or other key personnel, so you have to rely, as a user of these financial statements, you have to rely on the notes to give you the answers to questions you have as you complete your analysis. So hopefully you've gotten some insights now where you could take a set of financial statements and related information and use some of these tools to determine, is that company healthy? Is that company sick? Is it performing well? Are there opportunities to improve performance? Would I loan money to it? Would I invest in the company? These are questions that business professionals ask and answer every day, and hopefully you can start to do some of those same things.